Our other guest for today, Kranthi Bathini, who's the equity strategist at WealthMills Securities, is joining in this morning. Good morning, Kranthi. Great to have you on the show. First of all, I want to ask you the fact that, FII flows have been a major driver of the rally that we have seen on the Lal Street. And over the last few sessions, in fact, FIIs have turned sellers, especially after the Fitch downgrade of the credit rating of US, right? But do you think this is just a temporary, phase, and that FIIs will come back to India, given the fact that, we have seen a lot of positive commentary coming in around India's growth trajectory and how, it is better placed vis-a-vis China. So what are your thoughts on where flows are headed from here on?
Definitely, Nandita. The markets have risen from March lows around 15%. It's mostly fueled by the FII flows, and FII flows around Indian market received a net FII flows of around $15 billion, which is significant in the emerging market space. And what we are going to foresee in the coming future is these FII flows tend to go up further. There will be incremental further flows increase on a regular basis with respect to the FII flows are concerned. And what we need to emphasize, Nandita, is the quantum and also the segments of FIIs. What we are going to see is majority of the FIIs right now, what we are receiving is there are some kind of sovereign funds, pension funds, our flows are coming into the Indian markets. This is not a hot money, just comes and goes. It's a long only money, which believes in India's growth story. That's where the Indian market stability, what we are witnessing. And the setup of the market, in terms of the fundamentals, in terms of the macro data, is completely in favor of FII flows at this point of time. So we can expect the FII flows to be continued. There might be 1-2 days blips. That's a part and parcel of the story. But what we can expect is there will be a resilience in terms of the FII flows into Indian markets going ahead.
All right, that's about flows around India. But let's also talk about the sectors, Kranthi. We've seen autos, realty, in fact, rate-sensitive basket do fairly well this year itself. But pharma has started participating as well. And on a YTD basis, the index, in fact, has given returns of over 20%. And the index has hit a fresh high as well. But, at this juncture, which is a theme that you would advise investors to look at? Should it be the rate-sensitives or defensives like pharma and IT, given the fact that, earnings may have disappointed this quarter, but for the long run, a lot of experts are advising investors to look at large cap IT at these levels. And, there is the manufacturing theme as well, given the fact that, government's Make in India push is boding well for some of these sectors like defense, railways, and the likes. So which is the one sector that you would advise investors to look at this juncture?
The one thing, if you go purely with respect to the valuation perspective, Nandita, at this point of time, what we are witnessing is the valuation comfort with respect to the vis-a-vis compared to with the sectorial valuations are concerned. Of course, you rightly mentioned that the pharma sector, the valuations looks attractive in a longer term basis. What we are witnessing in pharma is a complete bottom out in the pharma sector. The sector was an outperforming performer during the COVID time, and the stocks valuations went to in a astronomical zone, and the valuations very stretched. And of late, what we witnessed in last 4 quarters, the valuation have been slightly drifted down, and the stocks are bottomed out in terms of the pharma sector is concerned. So right now, as we are heading towards the 20,000 mark, and so there are other sectors outperform, and pharma was the underperforming sector. And due to the current rally in the markets, what we are witnessing is some kind of bottom fishing that's taking place with respect to pharma sector is concerned. So if the investors have a long-term view, if the investor is coming with a 2 to 3 years perspective, pharma sector large cap stocks looks compelling at these valuations. So investors can take some positions in the large cap stocks with respect to pharma is concerned. Coming to the IT, as the lingering impact and the worries of US recession, and also the guidance what we received from the large cap IT stocks are concerned. So there is some kind of dichotomy, some kind of skittishness in terms of large cap IT is concerned in the medium to short term perspective. But Nandita, if we analyze the data, the US economy is going from strength to strength. All the macroeconomic indicators that are coming from US are quite strong. But there is a kind of dichotomy in terms of the budgets, in terms of the guidance with respect to large cap IT space is concerned. So for a medium to short term perspective, I try to avoid the large cap IT. But we need to take one contrarian view here. If the investor have a longer term perspective, definitely this is the time to accumulate large cap IT in a staggered manner in their portfolio. Whereas coming to the contrarian to the large caps, the mid and small cap IT stocks, majorly, if you track, they have been outperforming. They are quite resilient. So the reason is when we interact with these managements, the geography they operate and also the domain they are sticking to, they have been quite bullish. They have been resilient with respect to the geography they operate and also the domain expertise they have. They have not seen or forcing any kind of slowdown or any kind of negativity in terms of their guidance and revenue is concerned. So there is a mixed views that are coming. So the large cap IT in the medium term, one can avoid, but for the investor is a longer term perspective. This is the time they can start taking the positions in large cap ITs in a staggered manner.
Right. Kranthi, I want to also get in your thoughts on the entire new age basket, given the fact that there has been some visibility on the path to profitability, which of course the street was keenly watching out for. Zomato has handed in a 2 crore rupee profit a quarter ahead of what it had guided for earlier. There's a lot of buzz around Paytm after founder has increased stake in the company, and we've seen the likes of Policy Bazaar Delivery narrowing their losses in the first quarter. Which of these stocks are looking attractive? Do you see value in any of these new age companies now? We have a few queries coming in on our live feed as well. Investors want to know your thoughts on this pocket. Trilok wants to know your thoughts on some of these stocks. What would you advise investors to do?
Nandita, just to emphasize, okay, the stock had a lot of exuberance when the time of listing. And from the listing, all the stocks, majority of the stocks, what we mentioned, like names like Paytm, Nykaa, Zomato, they have drifted down, they have corrected. But they found the bottom after correcting around 60 to 70% on an average in each of these names. And what we are witnessing is during this phase of last 4-5 quarters, the companies have focused from top line. They come up with the profitability and the margin increase in terms of their revenues are concerned. Mainly the focus have become the profitability. So they changed the banner from top line growth to and market share. They are now coming up with respect to their profitability and increasing the margins. So majority of the stocks like names like Paytm, Zomato, these stocks have rallied from their bottom. They've risen around 50 to 60% from their recent lows in the previous quarters. So one good thing is the companies are turning towards profitability, which is a good sign for the investors, and the valuations also looks interesting. But the suitability of these kind of new age companies, because these companies can create a disruption in terms of the way we operate in the near term. So the high risk appetite investors, probably they can start accumulating these stocks as the companies are turning profitable. So at a dip, one can accumulate these stocks. But one disclaimer here is these stocks are suitable for, given the nature of the business and the nature of the revenue template they have. So the high risk appetite investors, definitely they can take positions in these stocks. But the risk averse investors, definitely it's not the space to be in.
All right, investors with high risk appetite can look at nibbling into some of these new age stocks on dips. With that, Kranthi, thanks a lot for taking out time and joining in this morning and sharing your thoughts with us. It was a pleasure having you on the show.
It's a pleasure to share my views with you.
Thank you. Well, with that.